What's up everybody? Chris here from projectoption.com, and in today's video we're going to discuss two option strategies that are actually less risky than buying shares of stock. So let's get right into it. Now, one common criticism of options trading is that the strategies are extremely risky. Now, this is something you'll hear all the time, especially from people that are not really that familiar with options trading, is that they'll tell you that the strategies are going to just completely wipe out your account. Now, while some strategies do carry massive loss potential, there are two strategies that are always less risky than buying 100 shares of stock, which are the two strategies that we're going to focus on in this video. Now, the two options trading strategies that are less risky than buying 100 shares of stock are covered calls and cash secured puts. Now, let's walk through these simple strategies and then look at some basic examples so that you can get a feel for how they work. Now, we're not going to get into the specific details of each strategy, but if you want to check those out, there are links in the description to each of the respective strategies, and in those videos you'll get a much more comprehensive breakdown of each of these strategies. But here's a simple breakdown of the covered call and cash secured put positions. A covered call position actually consists of selling a call option against 100 shares of stock that you already own. So by selling that call option against your shares of stock, you actually have a position that is less risky than simply owning the shares outright. Now, by selling that call option, you keep 100% of the premium if the stock price is below the call's strike price at expiration. So for example, let's say you buy 100 shares of stock for $25 a share, and you sell a call option with a strike price of $27.50. If the stock price remains under $27.50 through that call's expiration date, you will keep 100% of the premium that you collected for selling that call option. Now, what is a cash secured put? Well, a cash secured put is when you sell a put option on a stock that you'd like to buy, and you have to sell one put for every 100 shares of stock that you can buy with cash. Now, it's called cash secured because you have to put up all of the cash required to buy 100 shares of stock. Otherwise, you're actually selling a put on margin, and that actually has more risk than a cash secured put. So if you sell a cash secured put, you keep 100% of the premium that you collected from selling that put if the stock price is above the put's strike price at expiration. So let's say a stock is trading for $30 and you're willing to buy 100 shares if it drops to $25, but if it stays above $25, you'd like to just keep that premium. Well, you could go ahead and sell a put option with a strike price of $25, and if the stock price remains above $25 through the put's expiration date, you will keep 100% of the premium that you collected from selling that put. Now, in both cases, the option premium you collect lowers your break-even price and reduces the maximum loss potential of the position. Now, let's go ahead and look at some basic examples to really hammer this home and show you what that actually means. So let's say that you want to buy 100 shares of a stock for $25 per share, but you can also sell the 26 call option that expires in 30 days for $1. Now, if you sell an option for $1, you actually collect $100 in premium, since the standard contract multiplier for an option is 100, and that's because each option represents 100 shares of stock. So that $1 times 100 gives you $100 in premium that you collect for selling that call option. Now, here's how the long stock and covered call positions would compare based on these prices. So if you buy 100 shares of stock for $25, you don't collect any option premium, and that means your break-even price is $25. So you only make money on this position if the stock price is above $25 at some point in the future. Now, your maximum loss potential is $2,500 because if the stock goes to $0, you're going to lose $25 per share, and since you bought 100 shares of stock, you will lose $2,500. Now, in regards to the covered call position, you purchased 100 shares of stock for $25 per share, and then you sold the 26 call option for $1. Now, that means your break-even price is $24 because if the stock goes to $24, you'll have a $1 per share loss on your stock, but you will also have a $1 profit on that call option that you sold, because if the stock price is at $24 at expiration, that 26 call is going to expire worthless, and you're going to keep the $100 premium that you collected. Now that means your maximum loss potential is $2,400 as opposed to $2,500. Now why is that? If the stock price goes to $0, you will lose $2,500 on your long stock position, and that's because you lost $25 per share and you owned 100 shares. However, if the stock price goes to 0, that 26 call that you sold will also be worthless, and since you collected $100 in premium for selling that call, your profit on that call option will be $100. So since you lost $2,500 on the stock position and you gained $100 on the call position, your net loss is $2,400 as opposed to $2,500 when you just owned the shares. So as we can see here, the covered call position has less risk than just owning the shares of stock, and that's because you collect premium for selling that call option against your shares. Now let's switch gears and talk about the cash secured put position. So let's say you want to buy 100 shares of stock if it's below $50 in 30 days. Now let's say you sell the 30-day put with a strike price of $50 for $2.50. Now remember, that $2.50 actually represents $250 in option premium. Here's how the put position would compare to just buying 100 shares of stock at $50. So if you buy 100 shares of stock at $50, you collect no option premium and your break-even price is $50. Now that means if the stock price is below $50 at some point in the future, you will be down money, and if the stock price is above $50 at some point in the future, you will be up money. Now your maximum loss potential in that position is $5,000, because if the stock price goes to 0, you will have a $50 loss per share, and since you bought 100 shares, your loss would be $5,000. Now, in regards to the cash secured put position, let's say the stock price is $50 and you sell that 50 put for $2.50. Now that means your break-even price is $47.50 because you sold the 50 put, but you collected $2.50 for it. So if the stock price is $47.50 at the put's expiration date, that put option is going to be worth $2.50, which means you will not have any losses or gains on that position. Now, if the stock price goes to $0, your loss will be $4,750. Now, why is that? Well, we just discussed that if the stock price goes to 0, then you would lose $5,000 on your long stock position, and that's because you bought shares at $50 per share and you bought 100 shares. However, if you sell the 50 put for $2.50 and the stock price goes to 0, your effective purchase price of those shares would be the strike price of the put you sold, which is $50, minus the premium that you received, which is $2.50, which comes out to $47.50. So if the stock price goes to 0, you're essentially going to be buying 100 shares of stock for $47.50, but since that stock price is currently $0, you would have a $47.50 loss per share, and since each option represents 100 shares of stock, your loss would be $4,750. Now the bottom line is that the covered call and cash secured put strategies will have less loss potential than simply buying 100 shares of stock. Now, as we just explored, the loss reduction stems from the fact that both strategies collect option premium, which reduces the break-even price and maximum loss potential compared to just buying shares of stock. Now, unfortunately, it's not all upside when comparing these two strategies to buying shares of stock. The downside is that both positions have less profit potential compared to buying shares of stock, and more specifically, if the stock price rises substantially when these two positions are on. So just remember that there is always a trade-off, and by taking less risk, you do have less reward, but if the stock price doesn't go anywhere and remains flat, then both of these two strategies that we've discussed in this video will outperform a long stock position. The only time that a long stock position will do better than a cash secured put or a covered call is if the stock price rises substantially during the time that you have those positions on. Well, we've just covered a ton of content in very little time, so let's go ahead and do some concept checks to recap what this video covered. First and foremost, options can be highly risky, but there are strategies that have less loss potential compared to just buying 100 shares of stock. The covered call and cash secured put are two such strategies, as the collection of option premium reduces the break-even price and the maximum loss potential compared to buying 100 shares of stock. And lastly, keep in mind that there is always a trade-off. So in the context of cash secured puts and covered call positions, that decrease in loss potential compared to just buying shares of stock equates to less profit potential. So if the stock price surges in value after putting on a cash secured put or a covered call position, the long stock position is going to perform considerably better than having those option positions on. However, if the stock price trades flat or even decreases slightly, then a covered call or cash secured put position will both outperform just owning shares of stock, because when you own shares of stock, the stock price has to increase for you to profit. Thank you so much for watching this video, everybody. I hope you enjoyed it. If you did, please go ahead and give this video a like, subscribe to our YouTube channel so that you can get all of our future video content, and feel free to check out some more videos by clicking on that video on the right hand side.